Hello, everybody. So some of you have been asking about StoneCo STNE, and I decided to make a quick video about Q1. The reason why I didn't make a video is, well, A, I'm on vacation, but B, there's not much to report. I mean, this is a steady, heady business. This is a business that has still been forgotten by Wall Street, and I think the management is trying to do its best to show off to Wall Street that it can generate net income, and this business, in my view, is slowly becoming a cash flow and a value cow, and that's actually okay because they're still growing very fast at 31% year over year, and they're predicted to grow more over the next 12 months, as we'll see. So the business is growing fast, above my 30% threshold, and in addition to that, it has profits, which is what Wall Street should absolutely love. But as you know, I use revenue as a proxy of product adoption, and I try to invest in companies whose products get adopted and adopted much more than other companies. And so when I look at revenue, how's revenue doing? How am I feeling about the revenue? Well, the revenue's been flat between Q4 of 2022 and Q1 of 2023. Now, they do note it's because of the seasonality. And yes, when you go back to the old quarters of StoneCo, there is indeed quite a bit of seasonality, although that was the lowest quarter-over-quarter growth that they've ever had between Q4 2020, between Q4 and Q1. That was like the lowest, but it's still true that there is seasonality. So I'm not going to ding them on that. Additionally, one of the reasons why I'm not as upset when I look at this is the reason why they are seeing this drop in revenue growth is because they have stopped partnering, or what they call deprioritizing some sub-acquirers that have lower prepayment volumes and lower take rates. So if you see in the way that they focus on their payments, they're focusing on payments with high take rates, right? Like 2.3%. That's very, very high, 2.4%. And they're moving away from the accounts that give them smaller transaction fees. So in a way, they're actively avoiding payment volume in order to favor more profitable payment volume. And so this goes in line with their gross margins going up each time. Again, this is something that Wall Street should love. I'm okay with it because this is a long-term play for them. And the revenue growth, as I'll show, is still predicted to be quite high. So the lower total payment volume on key accounts seems to be a reason why there is lower revenue growth, and also their software sales are essentially flat when you go through a segment, and that's because they're not spending in marketing. In my view, they're spending very little in marketing. That Lynx acquisition may not have been the best acquisition for them. It seems like it's not going to be the chief driver of their growth, and so they're not focusing as much on it, which is too bad. But the core business of this company is still pretty good. Another reason why I say this is a company that seems to be headed towards a value stock, and it'd be interesting because Warren Buffett owns this stock, so it'd be interesting to see how much of the Warren Buffett philosophy is influenced in StoneCo. But yeah, if you look at the cash direction, we'll likely have $1 billion in cash next quarter, likely in Q2 or close to it. Right now, they have 794, let's call it 800 million in cash is what they have right now. And so the question is, do you need $1 billion in cash? Do you need more than 25% of your market cap in cash? I don't think so. It's not my style of investing. But again, I can't ding them on it because the growth is still excellent. And yes, we do have a little bit of long-term debt, 380 million of long-term debt. But they're, on Q3, they'll have 3 times as much cash as long-term debt. So that's still a lot of cash that they're generating, that they're not putting back into the business. And that's why I say, is Stone becoming a value stock? Because if you look, so let's do a quick analysis of their adjusted EBIT, which is a good proxy for cash flow for them. So let's say 76 million USD per quarter. This means that the run rate, assuming they don't grow, but they're going to grow this because you see, it's almost 400% year over year on adjusted EBIT. Okay, small numbers, but still, they're still going to grow this. But right now, if we just take a picture, put it still in time, and we do a 4x, simple 4x, we're at more than $300 million a year of cash flow at a $3.9 billion market cap. That would be a 12 to 13x on a price to cash flow. So that's cheap. That's cheap for a business that is still growing at more than 30%. That's why I say this company is becoming a value stock, not only in terms of valuation, but also in terms of what you would see in the management of typical value stock. And I'm not a value stock investor. So of course, I'd like to see more investment in the business. I'd like to see them put more money. And keep in mind, these numbers are with, almost $800 million in cash. So that's a lot. And, where's your marketing spend, StoneCo? When I look at this, when you go back on their P&L, you can see their gross margin is still amazing. You can calculate that, look at the numbers and calculate it back. We're still at 74% gross margin. So that's absolutely amazing. Type of business I love to invest in. But then if I look at their revenue, so the revenue's up 31% year over year, right? Q1 of 23 versus Q1 22, up 31%. Their marketing spend is only up 1.6%. So this means that relative to how much payment volumes they have, they're spending less in marketing, a big chunk less. Ideally, when a business grows this fast, I like to see them invest in marketing to grow even faster. So the question begs, if marketing expense had increased by 30%, would they have grown at 60%, 70%? How much would they have grown, right? Would they be in a position to kind of crush the competition or kind of go after PagSeguro much more strongly if they could invest in marketing? If they invested in marketing, they definitely can, but they don't want to do it. But they definitely can. I just don't know why they don't do it. But that's okay because, like I said, I can't ding them on it. I can't be too bad because StoneCo still has a tremendous amount of good stuff going for it. Analysts, if you go on Seeking Alpha, is where I get this data, analysts predict 39% revenue growth over the next 12 months for StoneCo. And their guide, if you look at their outlook, they've got a 6% for the next quarter, which implied outlook, right? When you do 6% times 6%, 4 times, that's an implied outlook of 26% that they've guided. So anywhere between 26 and 39%, if we take the midpoint, that's 33% growth. That's outstanding. That's very high for a business that has this type of margin, and for a business that's essentially dropped any increase in marketing expense. What they spent last year on marketing, they keep spending, but they're not spending more relative to their scale. And that is why their profits, if you go back to this chart, that's why the profits are going through the roof, because a lot of the money that they used to put in marketing is now not increasing as fast as the business. And they are prudently, but this is prudent. And for credit, by the way, it's understandable because the whole reason why the stock's so cheap is because they had an issue with their collateral. But they're prudent into credit, and they're slowly starting back the credit business, the loaning business to small businesses, similar to what Square is doing in the US. They're slowly starting it back, and they're slowly rolling the banking for small business. But this is prudent. They're not moving fast. And if these two businesses, credit and banking, end up like software being 10%, 10%, and 10% of a business, it's still something that we're not going to analyze much. We're still going to analyze the total payments volume. This is a payments company. This is a company that makes quite a bit of money on its payments and the payments it processes, and it's a toll road on the small business economy of Brazil. And again, why I can't complain, and I still love StoneCo and I still buy StoneCo, is they're still the cheapest or the second cheapest in my universe. If you look, this is a company that is still trading at 3 times gross profit. And they're still expecting to grow, so I lowered it to 33%, which is the new midpoint. They're still expecting to grow tremendously, and they're still, depending on the month, roughly trading in line with HIMSS. Granted, not growing as fast, but also sometimes cheaper, sometimes more expensive. Valuation is very similar, very very similar to HIMSS. So very attractive business in my view in terms of valuation. And I'll conclude with this, with some of these key questions. I'm very happy to own StoneCo, but one of the key questions that I have is piling cash on the balance sheet the purpose of this business? Like, is this, if you're a value investor, the answer is going to be yes, right? That's why Apple, for example, is a value stock. Apple just piles cash on the balance sheet. You have a lot of companies that do that. So if you're a value investor, you're going to see a lot of value in piling cash, but not for hyper growth investor like me who sees cash as devaluating really, really fast, especially in Brazil, right? That's why the channel is named Beat the Denominator. Brazil has high inflation, interest rates are high, but cash, if you look over the long run, has been devaluating fast. So I don't want to see them own $1 billion in cash, right? More than a fourth, more than 25% of the balance sheet of their market cap in cash and balance sheet. I don't want to see that, right? I would rather see them invest in marketing. Marketing worked well before for them. Why can't they invest in marketing? I know they're doing Big Brother Brazil, which is very popular over there, and that's like a big marketing campaign they have. Apparently, they get a good return on marketing spend on this. Maybe they can do other popular events, sponsor other popular things in Brazil. Advertise near what they call telenovelas, all that sort of stuff they can do. I'm sure they could find ways to invest in marketing right now. They're just not doing it as much as I perhaps would like to see, because if this is a business with low marketing, able to grow at 33%, imagine how fast it would grow with high marketing. Keeping in mind that once you gain a small business sets up StoneCo as a payment system, that small business is likely to stay for maybe a decade, maybe more, right? I know they have a lot of stores. They sell through a lot of stores that they have in local communities. Maybe you could open more stores and run that as a marketing expense. There's a lot of things you could do. You could also expand to new countries. What about Argentina? What about Mexico? These are new countries you could expand to. Or you could invest in the software that you just acquired. Worst case scenario for them would be to do, for me, but still acceptable, but I typically don't like that as much. But worst case thing they could do would be a share buyback, because the stock is still pretty cheap. But right now, all of that cash is sitting on the balance sheet. So all of these expenses would be fine, although I would prefer definitely investing in marketing. But if they don't do that, what I definitely would not like to see is an acquisition. Or even worse, a dividend, right? You want a business that reinvests. At least that's my style of investing. I want them to reinvest. If I see how the software business they're not focusing on in right now, despite them buying that software company, Lynx, I'm not sure that was a good acquisition for them to do. And so I would not like them to see them do an acquisition or pay a dividend. Either way, too much cash is a good problem to have, and that is why I can't ding them on it as much as I would like to see them grow even faster. They're still growing at 33%. It's a good problem to have. This is a good company. I sleep well at night owning it, and that's why perhaps it requires not as much day-to-day following as other companies that I cover on the channel. So anyways, this was not investment advice. This is only entertainment. I hope you were entertained. I appreciate all of your likes, all of your subscribes, all of your support. Thank you, and have a wonderful day.